Welcome to the InvestFourMore Real Estate Podcast. My name is Mark Ferguson, and I am your host. I'm a house flipper. I flip 10 to 15 houses a year. I own 13 rental properties with a goal to buy 100 by 2023. I'm also a real estate agent. I've been licensed since '01. I run a team of 9. We sell close to 200 houses a year. So on this show, we like to interview house flippers, landlords, and the best real estate agents in the business. So stay tuned for some great shows. If you want more information on my rentals, on the numbers, how I buy properties, check out InvestFourMore.com. Hey everyone, it's Mark Ferguson with InvestFourMore, and welcome to another episode of the InvestFourMore Real Estate Podcast. I have an exciting guest for today's show, Chris Prefontaine, who has been in the real estate business over 25 years, has built over 100 single-family and duplex houses, has owned his own brokerage as a real estate agent, has done condo conversions, raise the roof projects, and a lot of real estate coaching with smartrealestatecoach.com. So I'm excited to talk to Chris, hear his story, hear what he has to offer our listeners, and I hope everyone out there is as well. So Chris, thank you so much for being on the show. How are you?
I'm great, thank you, and thanks for having me on. I appreciate it.
No, thanks for being on. I know I was just on your show a little while ago, and I appreciate you being on mine. I really am excited to hear your story. You've done so much. Can you kind of start from the beginning about how you first got into real estate?
I actually, when I was speaking with you on our show live, I mentioned to you just briefly that I also grew up in a family business. It wasn't real estate, though. It was through the, well, technically 70s. I'm dating myself, but definitely in the 80s as I went through high school and college, I was in a family company. It did not operate directly in real estate, Mark, but what we did is we had branches all around New England for this business we ran. It's an industrial gas business, and my father would buy land, build our own commercial buildings, and have the company lease back from him. So I learned kind of that end of the commercial real estate, and then that gave me the itch, and I started following, way back then it would be Trump and others, but I started following them. And then in 91, when he sold the company, I went off and started doing what I call spot building. So we would go into neighborhoods that had maybe a onesie, twosie lot. We would secure the land with no money down because we didn't have any, and that was, the market was slow then. It worked. We would build a home using all the contractors and vendors and suppliers' money. They'd wait till the end of closing, would then pre-sell the home, and everybody got paid. So it was rather unique. I don't know if we could pull that off these days. That was early 90s. And then 95, I actually ended up buying a Realty Executives Franchise, had a group of small, 14 realtors or so that we managed, and we tried to stay on the kind of the higher productivity of the scale of national averages as far as deals done. We ended up doing what everyone said we couldn't do. We sold that in 2000 to Coldwell Banker. Now, I didn't sell the franchise because you can't. What I basically sold is my team, and then I gave the franchise back to Realty Executives. So it was neat. Everybody said, as an agent, you have nothing to sell, but we had a team and we sold it. And then we started coaching. So we started coaching all over U.S. and Canada. At the time, high-end realtors earning over $1 million, some of them upwards of $2 million. At that time, it was a lot of money. And then we started doing our own, as you alluded to, rehabs, raise the roof, etc., until the lovely debacle of 2008, at which time we totally pivoted, and to this day what we're doing and what I talk about in my book, and that is buying and selling without using your own cash, without getting loans, and just not getting into that messed up realm of personally guaranteeing things. So that was a mouthful, but that was the 10,000-foot view.
No, very good. Yeah, you have done a lot in your career and changed focus quite a bit, it sounds like. I have a lot of questions, but I guess I'll start. What was it like building new houses? I mean, was it fun? Was it stressful? How did that process work?
Yeah, I won't say we all. I messed it up because we had a good thing going. When we were spot building, the way I just outlined for you, there was no debt, there was no nothing. We basically had everybody hold on to the end. It was almost like they were all partners without being partners, right? So we loved it. To this day, we still, with the exception of one home, my wife and I have been married 31 years. With the exception of one home, we've built all our homes. She designs them, we build them. So we love doing that. We just don't do it as our income stream now. I wouldn't call it stressful. I would just call it that we got it to a point where we felt like we had to constantly spin deals, do the next deal, do the next deal, do the next deal, keep the crews happy. So I don't do a lot of rehab now or building, but we absolutely love doing it, especially personally still.
Okay, no, great to know. I've got 20 flips going right now myself, and I
Oh yeah,
know
I
how
remember.
crazy it is to manage contractors on those. And I imagine I've heard different stories. Some people think new construction is easier than flipping because you're starting from the very beginning and don't have any surprises, and others like it like the other way around. So
Yeah, I like new. If you ask me, I like new over the rehab, but it's just there's less uncertainty.
right, exactly. So starting your own brokerage, what made you do that? Did you want to build it into a business? Were you looking to, were you working with another brokerage at the time and just wanted to start your own team? How did that come about?
Okay, so when the building, I was going to get to the story and I got off track. So, okay, the transition into the brokerage was this, and thank you for the reminder. So the building business got real slow mid-90s, and not only did it get slow, we got off our focus. Instead of doing spot building, we started doing subdivisions. Clearly, you need cash, banks, money, investors for that. And when one of the subdivisions went under from permitting and other challenges, it took us down with it. And so we closed that down, and then I said, all right, well, what do we do now? Well, as a builder, I wasn't too fond of realtors, right? So I said, well, I can do that. I can go get my license, and I can hustle, and I can sell. So that's what got me into it. And then after 6 months, or maybe it was a year, being with Remax, I said, I want my own place. And so I got the time done, whatever it was at the time, to get your brokers, and then I bought a Realty Executives Franchise. And when I bought it, I definitely had the goal of, okay, 5 years max, I'm out. Whether I build it and sell it like I wanted to ideally, or whether I just close it, I knew it was a 5-year plan to just get myself back on my feet.
Oh, very cool. I've thought about starting my own brokerage as well because I'm an agent. I have a team underneath another brokerage. It's always been in my head to start another one. So one thing that always held me back before was I was very heavily involved in REOs, HUD homes, selling those for banks and the government. And their agreement is with your broker, not me. So even though I get all the
Right.
listings and do the money, there's no guarantee if I started my own brokerage, I would keep those accounts. So that was always one thing that held me back. But now that there's almost no foreclosures in Colorado and I've shifted away from that model, there's kind of nothing holding me back now. So I'm looking into that a lot more myself. What were some of the challenges of starting your own brokerage? I mean, I know there's a lot of management. Did you kind of designate someone who worked with all the agents, or were you the managing broker who's handling all that?
No, I was it. I followed at the time the Mike Ferry model, so to speak, and so we had minimums they had to meet. Literally, we asked them to leave, and so it was pretty hands-on and strict from a brokerage standpoint. And I guess in hindsight, I compare it now. When I look back, I say, look, I had to spend, I don't know what it was, 72 grand or whatever, between furniture and the franchise fee and all that to make, the franchise model is tiny, tiny, tiny spreads. And so I look back now and I say, man, compared to what we do, there's just no comparison or no reason I would go ahead and invest that kind of money again. I'd either stay on my own inside of someone's realm, and there are disadvantages like you just alluded to that, or, of course, do what we do now, which doesn't require you to go out and take out the bank loans and get yourself at risk and all that stuff that goes along with it.
Nope. No, sounds like a smart plan. I know if I did it, I would not go the franchise model.
Right.
I would just do my own kind of mom and pop shop because, yeah, I see
I agree.
a franchise in almost any business, you're paying so much money for the name. And I
Crazy.
don't know how worth it really is.
Right.
So after the brokerage, actually, let's keep talking about that for a second. You ended up selling, you said not the franchise because you can't sell a franchise, but your team to Coldwell Banker. And I talk a lot about this because I, help coach some agents as well. If you're a single real estate agent selling houses, you don't really have a business you can sell unless you've just created an amazing database of clients. Maybe you could sell that. But if you can create a team, have some kind of business or create an office, that is something you can sell. So how did you create that so that it was a sellable asset?
Yeah, we did, and there's great mentors. You know this. You and I both help people and coach people. So I just latched on to Mike Ferry at the time, and there's some fantastic ones now, Proctor and others. But at the time, it was him and his coach, Tim. Man, I'm racking my brain. Tim Wood at the time helped me build a team. So it was me. It was a full-time assistant, and she was had been licensed, so she was knowledgeable. A runner, like a sign runner and lockbox and paperwork, and then a buyer's agent. And that tight team, that was pretty tight. We did 100 to 110 homes a year for the last 4 years we were in business, and that was my goal when I started. I'm sorry, the last 3 years. It took me 2 years to ramp that up. And so that's what they bought. They wanted that market share and that volume. And then I had to sign a non-compete. I think it was a 2 or 3 year non-compete. And so I just literally got a desk at the Coldwell Banker local branch and started to do some deals, but I knew I was not going to be, banging the streets that hard anyway at that point.
No, that's great. I love that. And that's kind of how I've always told agents, if they want to ramp up, you can't do it all yourself. You've got to have an assistant. You've got to work on getting the business, the listings, whatever it is, so that you can hire a buyer's agent and then start shifting, the business to those agents. And all of a sudden you're a manager and you're not the one out there showing houses
Absolutely
all the time to everybody. So
yeah.
Great. So after the brokerage, you sold it. You got back into, was it the rehabs a little more? How'd that transition work?
Yeah, we were doing condo rehabs mostly, and then my wife was doing a few what I call raise the roof, so taking a ranch, blowing the second floor out, and then making a colonial out of it. We did 2 or 3 of those. She was written up in the Boston Globe at the time, and all the time that was going on, I was doing mostly 2 to 6 unit buildings where we bought them, rehabbed them, made the master condo documents, depending on what state we were in, and then flipped them as condos. And those were going, because of the heyday of the market, those were going before we finished literally slapping the paint on. The challenge with that was in the 08 debacle. I remember it like it was yesterday. It was February of 08 for me. Everyone hit that time period at a different stage, but I hit it in February of 08. And condos that were selling, one building in particular, for $172,000. We had 2 sold out of 6. Literally in 6 months, you could not get $50,000 for the same exact condo. And so literally the bottom fell out. I'm probably not talking anything new to any of your listeners. The national market fell out. And so we got caught in that for sure, big time.
Wow. What market was that in where that happened?
Well, for me, it was 08, but a lot of people had started in 07, right, with the shutdown of the financial market. So February of 08 is when we started feeling it really hard because we had commercial projects in the works. We had personally signed on all the loans that we had properties out there. So, I don't know, 23, 24, 25 properties. That became quite a part-time job just to work out the short sales, some foreclosures, the sell-off. I mean, it was just a part-time job to get all that done to clean up the mess.
Wow. No, a lot of people have gone through the crisis, and, depending on what market you're in, it's better, it's worse for some. And that's some crazy price drops right there. That is tough to
Sure is.
handle. So how did you change your strategy coming out of there?
Okay, so that's kind of where we are today. So what we did, and in my book, I opened the book with that horror story because I'm candid. I'm an open book. I'm pretty blunt, as you know from chatting before. And so what we did was we worked our way out of all that garbage from 08 till about 2012 or so. It took a good 4 years. In 13, we basically said, okay, what are the rules here? We're gonna buy on our terms. We're no longer gonna be at the mercy of the bank. So my book is called Real Estate on Your Terms for that reason. And what we said is no bank loans, no personal signatures. We're not using our credit for anything whatsoever. We're going to buy on lease purchase, or we're going to buy on owner financing, and we're never going to be on a loan. So if you look at today, for example, as a snapshot, we control at any one time around 65 or so properties, 95% of those being, maybe even 97% being single families. All of them are not in our name loan-wise, and all of them did not take capital to purchase. We recently had one of our events, Mark, and I had all our associates, so we have like people around the country we help. I had them all raise their hand and how many deals they had tied up. We had about $14 million in real estate as a group tied up together. And I said, okay, how much money do you spend to tie all that up? In the entire group of 24 of us, there wasn't anyone that spent more than $2,000 in total deposits for all the property they had up, and we control $14 million in real estate. So that's kind of cool compared to what it was in, prior to the 08 crash.
Yeah, no, that's amazing to be able to do that. You're going to have to walk us through then how you do a typical deal not using your own money.
Yeah, so there's a million different ways to go, right? Well, not a million, but there's several different ways to go. So let's talk about, I mentioned lease purchase and owner financing, so let's just kind of do a 10,000-foot dive on that, and if you want to go deeper, we can. So someone calls, and I don't care if it's debt-free or if it's fully leveraged or if it's over-leveraged. It doesn't matter. We do all 3 of those scenarios, and we do those on typically a lease purchase. Let's go that way first. So you have a home. It's worth $300,000. You owe $250,000. You can't sell it for whatever reason, or you just want all the money, and the market's not getting you that. The realtors or the market's not getting you that. And so you've got perceived 50,000 equity sitting there, let's say, for that example. We will structure a lease purchase with you whereby we take over your monthly mortgage payment on the underlying debt, the $250,000. then we'll say to you, hey, Mark, if you sold today and you had to pay a realtor and you had to pay closing costs and all that stuff, you wouldn't get your full 50, but here's what we're going to do. We're going to pay this mortgage for 36 months, 48 months, whatever it is, typically 36. We're going to, at the end of the term, we're going to pay off your loan, which will be less by then, and we're going to give you your $50,000. So we get the principal pay down benefit through that whole time, whatever the term is, and they know they have their $50,000 locked in for the end of the term. They couldn't get that today in the open market, and as long as they can wait, and they're not someone that for their family needs to go use that to buy a home tomorrow, it's a great solution. And again, if they can't wait, then I'm not their answer. So they have that $50,000. Someone might call us on the same house and say it's worth $300. I owe $310. Okay, I can still lease purchase it. I'm going to take over your payments, Mark, but I need more than 3 years because I need that principal pay down to go down. I need the market to come back. I might structure a 5 or 7. I've done 9-year terms with you. So my principal pay down over the term of that lease purchase is enormous. And then on all these homes, how do we exit them? We put a rent-to-own buyer in there that puts a sizable down payment down so we know they're a buyer, not some glorified renter. So that's how we buy and lease purchase, and we exit all homes on the rent-to-own side of things. I don't know if that was clear.
No, I think I got that, and that's an interesting strategy. So basically, the seller is giving you, leasing the home to you, you're paying their mortgage payments, they're moving out, and then you're finding another renter to move in there in a lease-to-own term. So they put a down payment down and are making the mortgage payments plus some, most likely, to you. So you're making money on it every month, plus you have the down payment. And eventually, after the term is over, you can pay off the loan, pay off the original seller.
Yeah, so you said it perfectly. So there's 3 paydays, the way you just said it. The first payday is the money up front. Second payday is the monthly spread that you alluded to. And the third is the back-end payday, because usually there's still some profit left there, as well as the principal pay down, which is sweet on a lot of the houses. So that's 3 paydays for every deal. And I'll give you the average. And, of course, there's no guarantees. Everybody's different parts of the country. But here's what I've seen with our properties and our associates around the country. We average on all 3 paydays combined. So when I give you this number, this means someone's going to, us or you, or someone's going to earn this number anywhere between 12 and 48 months, let's say, on average. And that number ranges from a low of 55 to a high of 85,000. I've had some 6 figures, but that's a rough average for all 3 paydays combined per deal. And so now you can see why when I go back to the franchise example where I had to spend 75 to have this little tiny margin, now I can go out and I can show others how to go out and create these 55 to 85 grand per deal paydays. Well, that's pretty cool. And that's all we do now. And we have a small family company here that does that. Just myself, my daughter Kayla, my son-in-law Zach, and my son Nick.
Oh, very cool. How are you finding, one question, I've had a couple people on the show who've done the lease to own. How strict are you on finding the lease rent to own tenants, the people who are putting a down payment and renting it? Are you looking at credit? Are you looking at job history, or do you let anybody in when they have the money?
This is a great question, Mark, because I don't get asked this a lot, and I'll tell you that a lot of my wannabe students or members who talk to me say, the reason I called you was because I researched you online, and I understand that your philosophy is I want to get the buyers cashed out. Other educators, and there's nothing wrong with it, but their philosophy, and they say it publicly online, I'm not talking out of school, they say, look, I don't care if they ever get financed because I got their down payment. Well, I just think from a moral and ethical standpoint, I'm not comfortable with that when I put my head down at night. So when I have a buyer come in, if you're our buyer, my son deals with all the buyers, he's going to put you through of course, the regular screen, credit, criminal, sexual harassment, all that good stuff, but he's also going to get the whole picture on your qualifications, your FICO, your front end and back end housing ratios, and when will Mark, as our buyer, be mortgage ready? Will it be 12 months, 18, 30? What is it? Then we're going to put that person in the home only after we know they can afford it and they can be mortgage ready. And we're going to put the term about 6 months, maybe 12 months, past what the mortgage ready date came back at, because that mortgage ready date tells me, yeah, Mark will be ready, but Mark will be ready if nothing changes. His life doesn't change, his credit cards don't change. So we got to make sure that we give Mark some extra time and we build that buffer in. So because of that, we will cash out almost all our buyers. We will have, out of 50 deals a year, 1 or 2 that have a life event. I'll give you examples: death, divorce, became disabled. I've had all these happen. And so they have to leave. And it's usually, Chris, I'm sorry. I had a guy apologize. I'm so sorry I let you down. I've got to go. His wife passed away, and they needed both incomes. So this will happen, but our goal is to get them cashed out.
No, that's fantastic because what you said does come up a lot where investors are getting the down payment. Once they get that money, they know they've made enough on the deal. They don't care if the buyers stay or go. They don't really help them out. But I think, no, that is a cool strategy where you're working and really trying to get them into the house, not just, make your money. When you're selling these houses, let's say the end of the term is 3 years, the end of the term's coming up. So you're saying almost all of your rent-to-own tenants will end up buying that house. That's how you exit the deal?
Yeah, exactly. So we also have, I've been putting these together since 13 now. So end of 12, beginning of 13. So we have quite a few, and we've gotten some nice surprise calls where I've written 3 or 5 year deals, and I get a call in month 11. I'm giving you exact examples. Month 11, month 15, where they say, "Hey, we're all set." So some I have to be proactive with, or my team does, my kids, and say, "Hey, Mark, are you on credit repair? Are you still staying? What's the date looking like? Do you need our mortgage guy?" And we have other people that just go to the credit repair. They do it because we told them it's part of their agreement. They, on their own, behind the scenes, find their own local bank, and they get it financed, and they call us and say, "Hey, we're ready. What do we do next?" And those are great. But the other half, we got to be proactive and kind of keep our thumb on the pulse, so to speak.
No, that makes total sense. What type of houses are you buying? Are they kind of low end, medium range? Do they need a lot of work? Are they in good shape? Or are you buying anything and everything?
We like the nicer homes. We like the move-in ready homes because keep in mind, even though I'm passing on the maintenance and repairs to my buyer, it's ultimately my responsibility if they decided they did have a life event and they got to leave or something's crazy with the house. So I prefer, we've had all kinds, but I prefer the nicer homes, and we prefer the 190 to 590, maybe even 690 in some markets. That's a sweet kind of category. Once you get over 750, we do them, but they're a lot harder to move owner financing or rent to own. And then under 190, it's, in our market anyway, it tends to be too many rehab type properties or things that are beat up, or 2 bedrooms. I'd prefer 3 bedrooms, nice homes, 190 to 590 type range.
Oh, very good. And I've always kind of been in all of my rentals and flips. We'll do some low end flips here and there. The mid range homes definitely, and even some of the lower to mid range homes have the most buyers, sell the fastest. And we've done some high end ones, and the costs to repair those properties and moving them, like you said, there's just a much smaller market for the higher priced homes.
Yeah, look, I'll tell you a quick story. We had a home, I actually was partnering with Ron LeGrand at the time. This was back in 13, and we had a high-end mastermind group. I think we all paid like $25,000 to be part of it, and we were trying to go out as a group and crack the code, so to speak, on getting these over $1 million deals and then selling them on terms, owner financing or lease purchase. And frankly, the 8 of us, there were some smart people in the room, and we just couldn't crack the code. And I got a home here in Rhode Island on the water, 6,500 square feet, $3.1 million. We tied it up for. We put it on the market for 3.9. That sounds great. But we had some bites, but we just could not move this thing in 3 years. We recently said to the owner, he's a business guy, and he says, "Hey guys, thanks for trying, but this ain't happening." So he let us have it for that long. We just couldn't do it. On the other side of the coin, we probably sold in that same time 300 between 190 and 590. So yeah, it's just a tougher market.
Yep, for sure. Nope, I've had the same experience, and yep, exactly the same. So you've done a lot. You've done the new construction, the condo conversion, raising the roofs, rent to own, the real estate brokerage. Are you happy now doing this current model, or do you have any big plans or changes for the future?
No, good question. We love this because at any one time, and I want your listeners to hear this piece, this is cool. At any one time, if you look at our portfolio, for lack of a better word, there's anywhere between a low of 1.78 million up to 3 million in sitting in cash outs ready to be taken, right, in the next 1 to 5 years. So we can literally, as a family and as a team, say, do we need any cash this year? Should we push hard on some of these buyers to get them done earlier, or are we okay? We can literally plan the year and look at this is how much is in the bank. By the same token, many of your listeners can probably already imagine this. If you have $1 million or 2 or 3 in your portfolio sitting there, literally with dates on them when they'll be cashed out, couldn't you then say, you know what? I think I'm going to take about 90 days off or 120 days off, and I'm going to go to Cayman Islands in our case, or I'm going to do whatever I want to do. And then plan your life accordingly. So you get to design your lifestyle and not be at the whim of, hey, I got to do another deal. No, it's very predictable. You can plan this thing out and have a blast with it. So we're going to keep doing this. We are augmenting what we're doing, supplementing what we're doing with some cool people that you've met too out there, that some do college housing and some do, which I used to do, and some do the Airbnb model. Well, those all work great with the lease purchase. So we're just adding to instead of changing what we're already doing.
No, very cool. And being in the real estate business as an agent and investor, I know exactly how unpredictable cash coming in and cash going out can be, depending on how many deals you have, when things are selling, the market. So that is nice having an idea of what your cash flow situation is like. So I think a lot of people, no matter what business they're in, a lot of times they ignore the cash coming in and going out. And I think that's where you really can get in trouble, is if you run short on cash, that can really sink a business quickly.
Oh, yeah. Cash solves everything. I mean, look, here's a quickie example. You can appreciate this. We had our event recently, and we had a woman there that I felt, I only bring people there that can help my students, and I felt that she could help them because she sets up credit lines. And I said, look, guys, you might not want to set up a credit line today, but I promise you, and you know this, Mark, there will be some curveballs that come at you and some headaches. And so you will sleep better at night knowing that if I get a headache, if I get a problem, I have this line over here on the side set up, and I don't have to pull cash out of my operating. It's a big deal. And so for the listeners, if you don't have lines set up and with the right, there's all kinds of people that do them, you definitely want to get that set up and let yourself sleep better at night. You will get a curveball or two. It's life.
Yeah, exactly. Well, Chris, I think that's about everything I had as far as questions for your business and what you're up to now. I know you said you've got a new book coming out. You've got your website that helps real estate investors. You've got your coaching programs. Tell us more about how you've kind of created all this to help others learn to invest.
Sure, and I think you do a good job with the show notes, so these guys can find any of this I talk about in the show notes. So you got the book was an Amazon bestseller when we came out with it in July. It's called Real Estate on Your Terms. And in the subcategory kind of goes with what we just talked about. It's creating continuous cash flow now without using your cash or credit. So that's the book. There's a free book on the site and some other things you'll have in the show notes. And then there's a cool webinar that I think I was mentioning too a little while ago that's free. I give you some cool content on that. It walks you through not just the lease purchase that we just talked about, Mark, but kind of all the nuances. And I'm a big advocate, and I do it in the book, of letting your listeners know and our students know what can go wrong. There's too many people that, you go in a seminar and it's all fluff, and you go out in the real world and you say, well, heck, Mark didn't tell me that. What's going on here? So I lay it all out. I go, here's what you might run into. Here's what we've run into, and here's how you can fix it. And so I'm pretty blunt with that. So jump on the webinar, jump on the book, and, have some fun with it.
Cool. Yep. No, we'll have show notes for all of that and links to there. So we'll get that for all of our listeners. Chris, thank you so much for being on the show. I mean, any other advice, anything we left out that you wanted to talk about or let our listeners know about?
Well, I appreciate you having me on. Let me just say this, because I didn't say it as far as my last thought, and that is that there are plenty of mentors, plenty of coaches. Mark and I aren't the only ones out there. And so and I also know that our personalities may or may not fit for you, right? That's just life. So find someone you can relate to that also did what or is doing what you want to do and be where you want to be, and then just latch on to them. I mean, literally, don't look left, don't look right, don't look backwards. Latch on to that mentor, model what they do, and don't look anywhere for at least a year. You'll have a great time and you'll have great success.
No, that's great advice. And yeah, I think we talked about this on your show, but a lot of investors, new people in the business, get shiny object syndrome, want to jump around to 8 different things. And it's very hard to be successful doing that. And focus is key. And like you said, there's a lot of people in this space coaching, a lot of people who haven't done deals in 10 or more years. And
that's it.
The market changes very quickly in real estate, especially after what we went through in the crash with financing and everything. So, no, great advice. Thank you so much for being on the show, Chris. Really appreciate it. Great information. We'll have a lot more links to your book and the webinar on the show notes. And I hope everyone had a great time. So thank you again for being on.
Thanks, buddy.